How liquidity became Europe's weakest link. It was always there. It was always assumed. And when it vanished, nothing worked. Liquidity sounds technical, almost boring, but inside Europe's banking system, it became the difference between survival and collapse. Not capital, not profits. Cash at the exact moment it was needed. For years, liquidity felt abundant. Money moved freely across borders. Markets recycled cash efficiently. Banks assumed they could always fund themselves tomorrow because they had done so yesterday. That assumption shaped everything. Banks shortened funding maturities. They relied on overnight markets. They optimized balance sheets for efficiency, not endurance. Holding excess liquidity felt wasteful in a system that appeared permanently liquid. Europe's integration reinforced the belief. Cross-border markets expanded access. Funding sources multiplied. If liquidity tightened in one country, another could compensate. The system felt deep, flexible, and resilient. But liquidity is not a stock. It is a condition. It exists only when confidence exists. When trust fades, liquidity evaporates instantly, even if assets remain. And Europe discovered this too late. The first warning was subtle. Funding costs rose unevenly. Certain banks faced hesitation. Others demanded more collateral. These were not failures. They were questions. And questions are enough to change behavior. As uncertainty spread, banks adjusted. They hoarded cash. They reduced lending. They stopped assuming markets would always reopen. What looked like prudence at the individual level became paralysis at the system level. Liquidity stopped circulating. Assets still existed. Capital ratios still looked acceptable. But without funding, balance sheets could not function. Even strong institutions faced danger if they could not roll over short-term obligations. Europe had built a system dependent on constant motion. When that motion slowed, weakness appeared everywhere at once. Not because banks were insolvent, but because liquidity was no longer guaranteed. This was a shock. Liquidity, once invisible, revealed itself as Europe's most fragile link, and the system was about to learn how quickly it could break. When liquidity tightened, reactions accelerated. Banks did not wait for confirmation. They acted on suspicion. Funding lines were reduced. Collateral standards increased. Access to short-term markets became selective, not automatic. This changed the system's rhythm. Overnight funding, once routine, became uncertain. Institutions that relied on rolling debt faced immediate pressure. Even a single missed renewal could trigger distress. Liquidity became binary. You either had it or you didn't, and the difference could be hours. Cross-border funding made this worse. Banks depended on markets outside their home countries. When stress appeared, foreign lenders pulled back first. Liquidity retreated behind borders, not by policy, but by instinct. National markets fragmented. Interest rates diverged. Access varied sharply. Banks in weaker economies paid more, if they could borrow at all. The promise of an integrated market dissolved under pressure. Central banks stepped in again. They provided liquidity directly. They extended maturities. They accepted broader collateral. These actions prevented collapse. But they also changed incentives. Markets adapted to backstop. Banks reduced reliance on private funding. They leaned on official facilities. Liquidity became public, not market-driven. This stabilized conditions, but reduced discipline. The system survived, but it transformed. Liquidity management became central to supervision. Regulators demanded buffers. Stress scenarios assumed market closure. Access to funding was no longer treated as continuous. This reflected a new reality. Liquidity cannot be assumed. It must be planned for. Europe learned that funding fragility spreads faster than solvency risk. That panic about cash can destabilize even healthy institutions. And that once confidence in liquidity disappears, restoring it requires authority, not persuasion. The weakest link had been exposed, not because liquidity was scarce, but because belief in its availability was. And belief, once lost, does not return easily. As the crisis deepened, liquidity became a source of pressure, not protection. Buffers that looked sufficient in calm conditions proved inadequate under stress. Banks discovered that liquidity requirements based on historical behavior failed when markets froze simultaneously. What had worked in isolation failed in synchronization. Fire sales followed. To raise cash, institutions sold assets quickly. Prices fell. Collateral values dropped. Margin calls increased. Liquidity stress fed solvency concerns, even when fundamentals had not changed. This was a dangerous loop. Liquidity shortages forced asset sales. Asset sales weakened balance sheets. Weaker balance sheets reduced access to funding. The cycle reinforced itself. Europe's financial architecture amplified the effect. Automated margin systems adjusted instantly. Clearing houses demanded more collateral. Systems designed for safety reacted mechanically, accelerating pressure at the worst moment. Time disappeared. Decisions once made over weeks were now made in hours. Management focused on survival, not strategy. Long-term plans were abandoned for short-term cash preservation. Central banks escalated intervention. They became lenders not just of last resort, but of first importance. Extraordinary facilities turned into daily tools. Without them, the system would not have functioned. This changed expectations permanently. Liquidity was no longer a market outcome. It was a policy variable. Banks adjusted their models. Regulators adjusted their rules. Stress testing shifted focus from capital losses to funding continuity. The question was no longer how much could be lost, but how long funding could last. Europe accepted a new truth. Liquidity crises do not unfold slowly. They arrive suddenly. And when they do, they redefine everything. The weakest link had reshaped the entire chain. What followed was a permanent shift in priorities. Europe stopped treating liquidity as a background condition. It became a central concern. Rules were rewritten to assume markets could close. Buffers were designed for stress, not averages. Survival time mattered more than optimization. Banks changed their behavior. They extended funding maturities. They reduced dependence on overnight markets. Liquidity management moved from treasury desks to boardrooms. Cash was no longer idle. It was insurance. Regulators reinforced a lesson. Liquidity stress tests became standard. Institutions were evaluated not just on capital strength, but on endurance. The question regulators asked was simple. How long can this bank function if markets stop? This altered the system's character. Efficiency declined slightly. Stability improved significantly. Europe accepted that trade-off. A system optimized for constant liquidity is fragile. A system designed to survive its absence is slower, but safer. After seeing how quickly confidence vanished, no one argued for returning to old assumptions. Central banks remained essential. Their role expanded permanently. They were no longer emergency responders. They were structural providers of confidence. Their presence reassured markets that liquidity would not disappear completely, even when trust did. But the lesson went deeper. Liquidity was never just about cash. It was about belief. Belief that funding would be there tomorrow. Belief that markets would open. Belief that hesitation would not become panic. When that belief failed, the system failed with it. Europe rebuilt around that truth. Today's banking system is more cautious, more buffered, and more aware of its own fragility. Liquidity is treated with respect, not assumption, because everyone remembers how quickly it vanished. Liquidity became Europe's weakest link, and by breaking, it reshaped everything. Sometimes the smallest shift in perspective becomes the beginning of a new future. How